So in this class, we're going to cover market discount, acquisition discount, and bond premium. So what I'm planning on doing is going through the whiteboard first and going through all the rules on the whiteboard, showing you examples, explaining the rules, and then using numbers. And then after I do that, I'll go back to the PowerPoint and then go over the rules again and refer back to what we did on the whiteboard. So the first thing is, what is market discount? So we know with original issue discount, the bond at its origination is issued for a discount, is issued at a discount. It's issued for $900 and at maturity it's going to pay $1,000. That's a bond that's originally issued at a discount. With a market discount bond, when the bond is issued, it'll be issued, let's say, for $1,000. The redemption price will be $1,000. So when it's issued, there is no original issue discount. We are going to talk about bonds that have both original issue discount and market discount, but that's later on. So let's start off with a bond that's issued for $1,000. The redemption price is $1,000. And I'm going to use an interest rate of 5%. And I know 5% is high. That's an unrealistic rate right now. But let's just assume that's what the rate was. As long as interest rates stay at 5%, the price of this bond is going to stay at $1,000 because it's paying a market rate of interest. What happens if interest rates go up? Interest rates go up to 7%. Well, now what happens to the value of the bond? The value of the bond has to go down. And the reason it has to go down is if someone were to pay $1,000 for the bond, all they're getting is a 5% coupon. Well, if interest rates are at 7%, no one's going to buy this bond if they're only going to get a yield of 5%. So let's assume there were 5 years to maturity on this bond. This bond would be trading for close to $900. And why is it $900? Because you're going to be receiving $50 a year in interest. But if interest rates are at 7%, you should be getting more than that. And the 900 might be closer to, let's say, 910. So you're going to get $90 a year over the next 5 years, which is going to be, on a straight line basis, $18 per year. And so if you're getting $68 of interest a year, and you can see my numbers aren't exact, but if you're getting $68 of interest on an investment of $910, you're getting close to the 7%. So actually the bond would probably be trading closer to about 940 or something, but it's going to be trading for less than $1,000. So that's my point. And so Congress said, well, the difference between the 1,000 and the 910 really isn't a capital gain. If someone buys this bond for $910, so that's going to be my purchase price, because I'm now buying it in the secondary market. This bond has been issued, it's been outstanding, and now it's trading in the marketplace. So I can buy it for $910. I'm going to redeem it in 5 years for $1,000. And when I redeem it, I'm going to have a $90 gain. And the question is, should that gain be capital or should that gain be ordinary income? And Congress looked at this and said, that $90 difference has nothing to do with the appreciation in the bond, that the bond has gotten better, that the credit of the company has gotten better. That's simply a replacement for interest. If this bond had a 7% coupon, it would be trading for $1,000. It wouldn't be trading for $910. So Congress said that difference of market discount should be recognized as ordinary income. It should not be picked up as capital gain. Now, that's easy to see when I hold it to maturity. So again, let's assume that we have a bond with a redemption amount of $1,000. And we buy the bond for $910. And there are 5 years to go to maturity. And instead of holding it for 5 years and selling it for $1,000, I hold the bond for 3 years. And then I sell for $970. And then I'll use different sales prices later on to show you the differences. So we're going to sell it for $970. So I know that my amount realized is $970. I know my basis is $910. So I know I have a gain of $60. Now the question is that $60 capital or ordinary? And so what Congress, the rule that Congress came up with is they said, what was the total discount? The total discount was 90. How many years were left to maturity when you bought the bond? And you go, oh, when I bought the bond, the time to maturity equaled 5 years. How long did I hold the bond? And I held the bond for 3 years. So what Congress says is take 3, the number of years, if we could do, or we could do it by months. Let's do months. So we would say it's 36 months divided by 60 months. Congress, in the law, it actually says to use days, but we don't have to use days in this class. Let's use months. And by the way, if I did 3 divided by 5 or 36 divided by 60, it doesn't matter. Either way, I'm going to get 60%. So I then take 60%, multiply that by the total amount of discount, and the total amount of discount is 90. And so the discount that's accrued during the time that I held the bond is 54. And the default rule is to use straight line. So this is using a straight line methodology. If you want to, you can make an election to use a yield to maturity methodology. You'll end up with slightly less discount. But for our purposes, let's just use straight line. So what this means is the first $54 of gain equals ordinary income. And then the remaining $6, or whatever the remaining gain is, in this case it's $6, equals long-term capital gain. So you can end up with long-term capital gain in this situation. And what that really means is that interest rates have gone down from the time that you bought the bond. And that's why the price has gone up by more than the accrual of the discount. So now we've got long-term capital gain of the $6, and we have $54 of ordinary income. Now, what if I sell the bond? So it's the same bond, but now we're selling it for $950. So again, my amount realized is $950. My basis was $910. I have a gain of $40. The entire gain is ordinary income. right? And that's because it's less than the $54 that would have accrued. So when you have the gain, you measure the gain against the accrued market discount. To the extent it's equal to or less than the accrued market discount, then it's all ordinary income. And then once it's greater than the accrued market discount, it becomes capital gain. Now, this is a much better result than if this was an OID instrument. If this was an OID instrument and I had accrued $54 of income, then that would have all been ordinary income as I was accruing it. So, and the other thing, the nice thing about market discount is we don't accrue it on a year-by-year basis. The only time you recognize the market discount is when you dispose of the bond. So that's a major difference between market discount and original issue discount. Original issue discount, we're accruing every year as we're holding the bond. We're picking up ordinary income. And we do increase our basis for the amount of the accrued OID. So in this case, we would have picked up $54 of income. Our amount realized would have been $940. I'm sorry, $950. Our basis is now 910 plus the 54 is $964. And we would actually have a loss of $14 on the bond. And that loss would be a long-term capital loss. So this is the worst of all worlds. We would have been accruing the income as we were holding the bond. We would be accruing it all as ordinary income. And then when we sell it, we end up with a long-term capital loss, which may or may not be deductible. You're going to need capital gains in order to be able to deduct the capital loss. So the market discount bond has two major advantages over an OID bond. You don't accrue the market discount currently into income. You only recognize the market discount when you either sell or redeem the bond. And if your gain is less than the accrued market discount, you just recognize that smaller gain as ordinary income. You don't recognize the entire market discount as ordinary income, and then end up with a capital loss that you may not be able to offset against it. So these are the general rules with respect to market discount. Now, what's interesting with market discount, and where there's another big difference between market discount and OID, is that for OID, everyone has the same issue price and everyone has the same amount of OID no matter when they purchase the bond. So with OID, all purchasers pick up the same amount of OID each period, because it's what the bond just accrues at its yield to maturity, and everyone uses that same yield to maturity. And regardless of your purchase price, everyone has the same revised issue price. So everyone has the same amount of OID every year, no matter when they bought it and no matter what their purchase price is. With market discount, everyone has a different amount of market discount. Why? Because market discount is equal to the redemption price minus your basis. So if we have that same bond and it's got a $1,000 redemption price, and I buy it for $950, my market discount is $50. And I'm going to do all my testing based off of the $50. You buy the same bond and you pay $960 for it, your market discount is $40. So it's the same bond. We both have different market discounts. We both bought it at different times. So we're going to be amortizing it based on our individual days left to maturity. So we're going to be amortizing over different time periods. And so it's going to be rare that two people who have the same bond and they both bought it at a market discount are going to be amortizing the same amount. It's going to be a coincidence. With OID, that's just the rule, so it will always happen. So when we have a bond that was originally issued at par, it's very easy to see what the market discount is. You just compare the redemption amount with your purchase price, and the difference is your market discount. What happens if you have a bond that was issued with original issue discount and it has market discount? So how does that happen? We have a bond that's issued for $500, let's say. It has a 0 coupon. And it's going to mature in 10 years for $1,000. This is going to come out to very close to a 7.2% yield to maturity. So let's assume that interest, so let's assume 2 years goes by and we're picking up, in the first year, we're picking up about $36 of income. In the second year, we're picking up $37 of income. So let's assume that after 2 years, the adjusted issue price is $573. Right? And again, 7.2% times 500 gives us 36, and then 7.2 times 536 might give us about 37. So again, I'm just rounding, but let's say after 2 years, the adjusted issue price, or the revised issue price, let's call it the revised issue price, is $573. But now interest rates have gone up. They've gone up to, let's say, 8%. So when you buy the bond, for $543. Well, now you have a bond that has original issue discount and a bond that has market discount. It has original issue discount remaining. Of $427, and that's going to be picked up ratably. Well, not ratably, that's going to be picked up on a yield to maturity basis over the remaining 8 years. But now you also have market discount. And the way you compute the market discount is you compare the revised issue price of $573 with the purchase price, with your basis. And that's going to be $543. And so your market discount on this bond is going to be equal to $30. So when you dispose of this bond, and now let's say you dispose of the bond 2 years from now, only with respect to the market discount. So there were 8 years to maturity. We held for 2 years, held for 2 years. So we would say, okay, 2 divided by 24 divided by 96 times 30 is a quarter. So that's a quarter of 30 is 7.5 of market discount has accrued. Now, in order to determine your basis, you would also have had to have picked up 2 years of original issue discount, added that to your basis, compared that amount of basis to your sales price, and then see what your gain is. So after taking into account the OID, so you would take into account the OID. So let's assume your basis in the bond now, because we've got 2 more years of OID accruing. Let's assume that's $75. So our basis in the bond is the 543 plus 75 equals 618. And we now sell the bond, so our amount realized is 630. So now we have a gain of $12. Well, how much was the accrued market discount? The accrued market discount was $7.3. So of the $12 gain, the 7.3 is ordinary, and our long-term capital gain is 4.7. So it gets a little more complicated when you have to do market discount on a bond with original issue discount. But this is the way you would do it. So you would just treat the two independently, and then you would combine the results, and that's how we would get our answer. If we sold the bond, let's assume, again, we have these numbers. So our basis is 618. And we sell the bond, the amount realized is 610. Well, now we're going to end up with a capital loss. And it'll be a long-term capital loss. Of $8. We're not going to have, and we're going to have zero market discount. I mean, we actually lost, we're selling it for less than our basis. Since we're selling it for less than our basis, our market discount is zero. And we have a long-term capital loss because of the accretion of the OID for the prior 2 years. So as the OID was accreting, we were picking up interest income, and now we end up with a capital loss on the sale. And that was all due to the OID. That has nothing to do with the market discount. The fact that market discount should have been accruing as well, and we didn't recognize any of it because interest rates went up even further, so the value of our bond just kept decreasing. That was the reason that we didn't end up with any market discount income. Right. So these are the basic rules for how much market discount we pick up. And again, the only time we recognize market discount is on sale or redemption, not on an annual basis. So now people said, well, this is interesting because I don't have to pick up the market discount into income. So let me go to another example now. And someone says, wow. So we have a bond that's originally issued for $1,000 and no OID. Right, let's get rid of the OID. I buy the bond for $900. And it has 5 years to maturity. So I've got 5 years to maturity. I've got the bond purchase for $900. It's got $1,000 it was originally issued for, and it has a 5% coupon. When I buy the bond, though, I borrow the $900 to buy the bond. And I pay 6% interest to buy the bond on the loan. So my interest expense in the year is $54. And I want to know, can I deduct the entire $54? Well, we look at this and we say, how much interest income did you pick up? So my interest income is $50 because it's a 5% coupon. So to the extent I have interest income, I can deduct the interest expense. Now I have excess interest expense. And Congress says, compare your excess interest expense. So my excess interest expense is $4. I say, how much market discount accrued during that year? And the market discount that accrued during the year, if I bought it for 90 and there were 5 years to maturity, if I bought it for 900 and there were 5 years to maturity, there's $100 of market discount on the entire bond. It's 5 years. I picked up $20 of market discount. And Congress says, well, you didn't pick up that income, but economically, you should have accrued $20 of income. Since your excess interest expense is less than your market discount, you can't deduct any of the excess interest expense. You can only deduct the excess interest expense to the extent it exceeds your market discount, because that means you really lost money. So in this case, we can't deduct the excess interest expense unless it exceeds the market discount that was accrued for the year. Right? So we can't deduct the $4, but what we can do is we can carry forward the $4. And then we do the test all over again next year with the actual amount of interest expense, add the $4 on, again, compare it to how much interest income we picked up the next year. And if it exceeds it again and we have more excess interest expense, once again, we're going to say, what was our market discount in total now for the 2 years? And unless it exceeds the total market discount over the 2-year period, we can't deduct that. We just keep carrying it forward and carrying it forward. And eventually, the interest expense will all be deducted in the year of disposition. Or redemption. When you finally get rid of the bond, then they let you deduct all the interest expense that was disallowed in prior years. All right. So again, so let's assume instead of borrowing at 6%, we borrowed at 8%. So we borrow the $900. This time the rate is 8%. So our interest expense is $72. Our interest income on the bond, on the coupon, was $50. We now have excess interest expense of $22, and we have accrued market discount of $20. So we're able to deduct $2. And that's because we really lost money economically. We really lost $2. We've had more interest expense that's accrued than the value that the bond should have gone up by. So to the extent we really lost money, Congress is saying you can deduct it. So in this case, we're deferring $20 of interest expense. And we're going to carry that forward to next year. And then next year, when we do our calculation, we're going to start off with $20 of interest expense. We'll add to that the amount of interest expense that we've incurred for that year, compare that to the market discount, and see if we can deduct it in the following year. And if we can, that's great. If we can't, then we're going to have to defer a portion again. All right. So if your interest expense is less than the coupon, we don't have any, excuse me, then we don't have any excess interest expense, and then you can deduct the full amount. So if our interest expense was $50 or less, you don't have to go through these machinations. You just deduct the full amount. Now, if you have a whole portfolio and you have a lot of bonds and you have a lot of borrowings and you can't match the borrowings with the bonds, if you don't want to do this, you can elect to accrue the market discount into income currently. And if we're going to elect to accrue the market discount into income currently, then this rule doesn't apply. But if you make that election, you have to make that election with respect to every bond you own, and it's a lifetime election. The only way to get out of that election is to ask the Internal Revenue Service to allow you to revoke the election. And whenever you have to ask the Internal Revenue Service for permission to revoke an election, they never grant it. It's very, very rare that they will ever grant you the ability to revoke an election. So you're stuck with this. If you're going to elect to accrue the market discount into income, which again, remember, means we're going to pick up all that income every year, we're going to increase our basis, and then we could end up with ordinary income and capital losses. The thing that we really wanted to avoid, and that we weren't running into that problem the way we were with OID, and we didn't have to accrue the income. We don't have to pay taxes early. If you accrue the income, you're going to have to pay the taxes earlier than the person who doesn't accrue the market discount. So I find that it's very rare that somebody makes the selection. Right. So those are the rules with respect to market discount. So now what I'd like to do is go back to the PowerPoint, go through everything on market discount, and show you the rules as they're written in the code or in English. And then I'll keep pointing back to what we did and how we applied those rules with our examples. Then we're going to get to acquisition discount, and I'll give an example again on the whiteboard, go through the rules, and then finally we'll finish with market premium. So let me do that now. Let me go to the PowerPoint. So here, right. So right now we're going to focus on the market discount. So what is market discount? The code section is 1276. It's a bond bought at a discount, and it's due to a price movement after it was issued. So this is, again, it's because interest rates typically have gone up, so the price of the bond goes down. And as I said, Congress's was intended to treat discount as interest income because most likely that's the reason that the bond is trading at a discount. It's because of changes in interest rates, and it's really a substitute for interest income. Now, what if we have an issuer that was in good credit standing when it issued the bond? So it issues the bond at 5%, interest rates are 5%. Interest rates stay at 5%, but the credit quality of the issuer goes down. So the market value of the bond goes down. Well, unfortunately, those bonds are caught by the market discount rules. And even though that discount really shouldn't be treated as interest income, it is. When we go to the end, I'm going to tell you a practical rule that the accounting firms and law firms have adopted, and the IRS, to my knowledge, hasn't contested. So we'll see what they do, how people are dealing with bonds that have really gone down by a lot because of the issuer's credit quality dropping. Again, the rule in the code in 1276 is that the gain on the disposition of any market discount bond shall be treated as ordinary income to the extent that it does not exceed the accrued market discount. So that's what we computed in that example when we took the days held over the time to maturity, multiply that by the total market discount, and came up with a number. We said any gain up to that amount is going to be treated as ordinary income, and any gain in excess of that amount is going to be capital gain. We could ignore the partial payment rule. Let's just forget about that. What is a market discount bond? It says any bond with a market discount. What's a market discount? It's the excess of the stated redemption price of the bond over the basis of such bond. And that's what we did. And that's why it's going to be different for each purchaser. Each purchaser will have their own basis. So you look at the redemption price of the bond, compare that to your purchase price, to your basis, and that's going to tell you what your market discount is. And then we have a special rule that if the bond has OID, instead of using the stated redemption price, you use the revised issue price. And I went over example with that. So if a bond was issued 2 years ago and it was OID, you would take the OID that was picked up in the first year, the OID that was picked up in the second year, add those two amounts to the original issue price, and that would become its revised issue price. And then you would compare your purchase price with the revised issue price to see if you have market discount. So we've just gone over the rules of bond and what revised issue price is. And then the rule is when you accrue your market discount, do it on a straight line basis. Now in the code, they say number of days that they've held the bond bears to the number of days from the date that the taxpayer acquires the bond to maturity. For our purposes, we can use months if that's easier. We can use years if I make an example and I have it exactly in years. You don't have to do days for our course. In real life, you would do days because that's what the rule is. And the difference is going to be minuscule to the extent there is a difference. If you want to, you can elect to use the constant interest rate method. So you would do a yield to maturity calculation. That will give you a slightly better result. For individuals, most individuals will just do it on a straight line basis. If you're a hedge fund, a partnership, and you can do the computation, you might do the yield. You could use the yield to maturity, and it'll give you a small amount of accrued market discount. Then we talked about the deferral of interest deductions. And again, you look at the net direct interest expense. And that's only going to be allowed to the extent that such expense exceeds the portion of the market discount allocable to such year. But what does net direct interest expense mean? What it means is that you take your interest paid accrued on the debt over the aggregate amount of interest income. So that's why the first thing we do is we say, how much interest expense did we incur? That was the $54 in my example. How much was the interest income that we picked up on the bond from the coupon? 50. So our net direct interest expense is only $4. Then we compare the $4 to the accrued market discount on the bond. And if it's less than the accrued market discount, that amount has to be disallowed and carried over to the next year. And then in the next year, we do the calculation all over again, see if our interest expense is less than the coupon. And if it is, then the whole thing is just fully deductible. When the interest expense then in the second year is greater than the coupon, we then compare it to the market discount in the second year. That amount then again gets deferred, and we can deduct the excess if there's excess. And then again, to the extent anything is disallowed, it goes to the following year. And eventually, all the interest expense will be deducted in the year that you get rid of the bond. If you don't like that rule, you don't want to have to deal with figuring out how much of your interest expense has to be deferred, you can elect to accrue the market discount into income. And if you do that, none of these rules apply because you're just picking up the income on a current basis. You increase your basis, and if you sell it and you have a loss, you're going to end up with a capital loss. If you sell it and you have a gain, you're going to end up with a capital gain. But none of these rules apply if you're going to accrue the market discount currently. Again, once you make the election, it covers every bond that you own. And the only way to get out of this election is to receive permission from the commissioner, and that is going to be extremely, extremely unlikely. What are the exceptions to the market discount rules? Short-term obligations. If we have a bond that was issued and at the time of issuance has less than 1 year to maturity, these rules don't apply. It's not a bond that was issued 10 years ago and you're buying it now with less than 1 year to maturity. That bond will apply. These rules will apply. So it's only for bonds that at the time of issuance do not have a maturity of more than 1 year. United States savings bonds, installment obligations, an original issue discount bond acquired at its original issue. Unless the basis is less than the issue price. I would just forget about the last bullet. That's just going to be very rare that's going to apply. And if we have a tax exempt bond that has market discount, they don't just make you defer the interest expense under 1277. They actually say no, so that code section 265 applies, and code section 265 will actually disallow the interest expense with respect to a municipal bond or a tax exempt bond. So the interest deferral rule doesn't apply to tax exempt bonds. Instead, the interest expense is just completely disallowed. So now I want to go back to what happens when a bond goes down in value, not because of a change of interest rates, but because of a change in credit quality. So GM issued a bond at par due to its poor credit quality. The $1,000 face amount bond with a 5% coupon is trading for $100. So it is extremely depressed. And it wouldn't have been GM, but I'm just using GM in this example. Is this the type of bond that these rules were meant to apply to? And the answer is clearly not. These rules were meant to apply to bonds that have gone down in value solely because of changes in interest rates. Do the rules apply to this bond? When you read the code, the answer is yes. The rules do apply to this bond. Do taxpayers treat this bond as being covered by the market discount rules? And there the answer is no. There's been a consensus. And the consensus is if the price of the bond is 50% or less than the face amount, we're not going to apply these rules. If that's not what these rules were meant to apply to, and if we have a gain on those bonds, we're going to pick that up as capital gain. We're not going to accrue market discount on these bonds. It just makes no sense. And now if there's only 1 or 2 years left to maturity, they might use a number higher than 50% in deciding whether to apply these rules or not. And the IRS hasn't challenged, to my knowledge, they haven't challenged anyone who's done that. But I think the accounting firms and the big law firms got together and decided that's what we're going to do with people who buy distressed debt. We're not going to apply these market discount rules. There was a change in the law a few years ago to section 451. And in section 451, they came up with an all events test. And they said that when all the events had been satisfied, that income has to be included no later than when it is recognized for book purposes. And from the legislative history, it was clear that they meant this to apply to market discount bonds. And you only pick up income, you don't take deductions under this rule. So under this rule, income had to be accelerated, but losses or expenses could not. So if we have a hedge fund that buys distressed debt and they use mark to market for book purposes, they buy the bond for 80, and at the end of year 1, the bond has a fair market value of 95. The company is recovered, it's doing great. Well, under section 451, that would have been $15 of income. And then in year 2, it goes back and has a problem again. So now its credit has gone down and the market value of the bond goes down to 85. So now you would think you have a $10 loss, but 451 only applies to income. You can't accelerate losses for tax purposes. And then so a lot of hedge funds, a lot of mutual funds were getting very upset about this rule. And so the IRS in 2018 came out with a notice and said, by the way, when we write regulations, we're going to make clear that the taxation of market discount bonds will not change due to this change in 451. So even though the legislative history made it sound like these rules were going to apply to market discount bonds, the IRS changed their mind and said, don't worry about it. We're not going to apply these rules to market discount bonds. So nothing has changed. So we could just disregard section 451 when it comes to market discount bonds. Okay, I'm now going to go into acquisition discount. I'm going to do it from the PowerPoint. So I'll do it in reverse order. We'll go through the rules and then I'll show you how it works on the whiteboard. But this is really much simpler. So the rule is with respect to a holder of a short-term obligation, because as you saw, both the OID rules and the market discount rules didn't apply to any bond that was at the time of its issuance was issued with a maturity of less than 1 year. So these are the rules that apply. And the rule is include daily portions of the acquisition discount for each day held during the year, plus any interest payable on the bond other than acquisition discount. So basically, they're telling you to pick up the daily portions, just like OID. What is a short-term obligation? A short-term obligation is anything that is held by any of these entities. So if it's held by an accrued method taxpayer, it's held for sale by a dealer, held by a bank, held by a regulated investment company, part of a Section 1256 hedging transaction, held by the person who stripped the bond or coupon, held by a pass-through entity. So this is very encompassing, but what is missing? What's missing are cash basis taxpayers. Cash basis taxpayers are not subject to these rules. Cash basis taxpayers love these things. They don't have to accrue the discount. They can wait until they sell the bond or until the bond matures, typically when the bond matures. So when banks or other entities issue debt with a 364-day life, they're marketing those to individuals. Individuals will buy those. They don't have to pay tax on the phantom income, and they then wait till they redeem it, and then they pick up their income. But if you're one of these people, one of these entities, then these rules apply to you. So what are these rules? And again, it's the same stated redemption price over the taxpayer's basis. It's all of these short-term debts. And the daily portion is not the way we do the daily portion for OID. It's the number of days after the date was acquired up to the date of maturity, which means you use straight line. So if you buy a bond with less than 1 year to go to maturity, and you're one of the people that are covered by this section, you accrue the income. You accrue the income on a straight line basis. If you're a cash basis taxpayer, you do not accrue the income. You wait until you dispose of the bond, and that's when you pick up the income. And then we have the same rule here that we had with the market discount rules. So if we have a cash basis taxpayer and they're not picking up the income and they're going to borrow to buy the bond, Congress doesn't want them to be able to deduct the interest expense. So they have the same rule. The net direct interest expense is allowed as a deduction only to the extent it exceeds the sum of the daily portions of the acquisition discount and the amount of interest payable on the bond that accrued during the year, but was not included in income during the year. So if you have income that wasn't includable during the year, we're not going to allow you to take interest expense deductions. If you have income that was accrued during the year, then you can take that amount of interest expense into account. And if all the income on the bond is included in income, then there's just no deferral of interest expense. How do they define net direct interest expense? They take 1282C, which is the code section that deals with acquisition discount. They just refer you back to rules 1277B and 1277C. And like, they don't define it. You now have to go back to 1277B, 1277C, and apply those rules. Those are the rules we just went over with respect to market discount. So let me go to the whiteboard and let's go over an acquisition discount bond. So let me just make this bigger. Let's erase all of this. Move this out of the way. And let's do text. So we issue a bond. It's got 364 days to maturity. And the issue price is $950. And it has a 0 coupon. So if I'm subject to the rules, I'm an accrual basis taxpayer, I'm a regulated investment company, I'm one of those companies, taxpayers that were listed on that PowerPoint sheet where this rules apply, I accrue the $50 over the 364-day period. And I'm going to be including all the income. So because I'm including all the income, there is no disallowance of interest expense if I finance the purchase of this bond. Right, so the rules are really simple. We use straight line, and we don't have to worry about any disallowance of interest expense. If I'm a cash basis taxpayer, I don't have to accrue any income. And when I redeem the bond, I have $50 of ordinary income. So all the income, though, is ordinary. It's not capital, but I've got $50 of ordinary income. And the beauty of it is so if I bought the bond in March of this year and it matures in March of next year, between March and December, I don't have to accrue any income. I don't have to pay my taxes early on the income. I can wait until I redeem it next March, and then I'll pick up the income all in the following year, and I'm very happy. The interest expense disallowance rules are going to apply. So if I finance the purchase of this bond and I'm not accruing any income, so if no income was accrued, then no interest expense could be deducted until the bond is redeemed. And again, with these bonds, the most deferral could ever be is 1 year. So if I bought the bond in March of this year, it has to be coming due by March of next year. So it'd be the interest expense that I took this year is going to be deferred until the following year. So it's until the bond is either redeemed or sold. And those are the rules for acquisition discount. They're really not that complicated. If you're a cash basis taxpayer, you don't accrue anything. If you're an accrual basis taxpayer or one of those entities, you do accrue it, and you accrue it on a daily basis. If you're accruing it, we don't have to worry about interest expense disallowance rules. If you're not accruing it, then you can't deduct the interest expense. Okay, so now the final thing that we're going to talk about today are premium bonds. You know what? I'm going to do the rules first. So I'm going to go back to the PowerPoint. We'll do the rules, and then after we do the rules, we'll go through an example. Oh, sorry. Okay. So So now bond premium. So bond premium is when interest rates go down. So now the value of the bond has gone up because it's paying a coupon that's too high. Let's say we issue a bond with a 10% coupon, interest rates go down to 6%. If you buy the bond for $1,000, you're going to be receiving $100 of coupon income on your $1,000 investment. But if interest rates are only 6% in the market, you're receiving too much. So the price of the bond is going to go up to reflect that it's getting a higher coupon. So what are the rules with respect to bond premium? The amount of any amortizable bond premium shall be allowed as a deduction. So we're going to be able to amortize the bond premium, and we're actually going to be able to take a deduction for it. So what's a bond? It's an evidence of indebtedness. What is the amortizable bond premium? The basis of the bond for determining loss, which is still going to be a purchase price, over the amount payable on maturity. And then they have special rules for call dates, but let's ignore those for this purposes of this class. So we're just going to do what's my basis in the bond, what's the redemption, the amount payable on maturity. That's my bond premium. The amount of the premium attributable to the year, and this time you must use the constant interest rate method. You cannot use straight line. And that actually is a pro-taxpayer rule. You're going to get larger deductions in the earlier years and smaller deductions in the later years. If it's a taxable bond, you must elect to be able to amortize the bond premium. And how do you elect? You just do it on your tax return. There's no special form, there's no special statement, you just do it. And then once you do it, the election is binding and it covers all bonds. There's absolutely no reason not to do it. So we'll go through an example and I'll show you why you're always going to want to amortize bond premium. Now, what's interesting, because in section 171A, so code section 171 is what's dealing with bond premium. Code section 171A says, we're going to give you a deduction. And then instead of repealing 171A, which is what they should have done, is they added code section 171E. And 171E says, you're not getting a deduction. What you can do is reduce the amount of interest income that you've accrued on your bond. And the reason they did that is if let's assume that the bond pays interest semi-annually and it pays on October 1st, April 1st and October 1st. And I'm a cash basis taxpayer and I buy the bond in November. Well, if I buy it on leverage and I buy it in November, forget about the leverage. If I just buy the bond and it has a premium and I buy it in November, I'm going to amortize that premium for November and December. And if it was just 171A, I would get a deduction for 2 months of the amortization. And so they said, no, that's not fair because you're not picking up any income. We're not just going to let you have a deduction. So instead they say you can only reduce your income by the amount of the bond premium. And in that case, I just wouldn't be allowed a deduction this year. It would carry over to next year. And when I got my first coupon that I would pick up, I would then amortize all of the premium up to that coupon. And then going forward, I shouldn't have a problem. I'm always going to have more interest income than the premium amortization. And so let me go through the rules and then we'll talk about this final planning technique. So let's go to the whiteboard. I have a bond with a very high coupon. So let's say the bond is issued for $1,000. It's got a 10% coupon. And again, I know I'm using crazy coupons. Interest rates drop. to 5%. So the value of this bond is going to go way up. Let's say the value now is $1,500. And let's assume there's let's assume there's 3 years. Let's assume there's 4 years to maturity. So even though we should be using the constant yield to maturity, let's just use straight line for our purposes. So what's my premium? My premium is 1,500 minus 1,000, right? The 1,500 is my basis. The 1,000 is the redemption price. The total amount of premium is $500. And let's assume that I've got 4 years to go to maturity, and we're going to use straight line. I can amortize $125 a year. That amortization is an ordinary is treated as an ordinary deduction because it reduces interest income. So in effect, it's reducing income that would have been taxed at 37%. So you want to make this election because you're getting the reduction every year. And if I don't make that election, when I sell the bond with no election, I'm going to have an amount realized of $1,000. I'm going to end up with an adjusted basis of 1,500. I'm going to end up with a loss of 500, and it's going to be a capital loss. That's awful. And it's going to be a long-term capital loss. So nobody, virtually nobody is going to not elect to amortize the premium. So the premium is going to reduce the interest income on the bond. And the way it would work in this bond, let's assume that I bought it on January 1st. So when I have 4 years to maturity, the first year I'm holding it for the entire year. I'm going to have interest income. And the interest income is going to be $100. And I'm going to have amortization of bond premium of all right, so the numbers I'm using isn't working out. The value is not going to go up to 1,500. That was too high a value. Let me get rid of that. And make it 1,200. So I apologize for that. That's what happens when I make up examples off the top of my head. So let's make the value 1,200. And if the value is 1,200 and still has 4 years to maturity, our amortization is going to be $50. And so our net interest income or our interest income now from this bond for the year will be $50. Because we have interest income on the bond, we have a 10% coupon on a $1,000 face, that's my $100. The amortization is 50 because I bought it for 1,200, there are 4 years to go. So my interest income is $50. And that's the way it would work. And if I didn't do that, I would have had interest income of $100. And then I wouldn't have a deduction until I sold the bond. And when I sold the bond, I would end up with a capital loss. So again, I apologize for using a bad number, but you would still, but it's the same concept. The premium now is 1,200 minus 1,000, which is 200. And you divide that by the 4 years, and that gives you $50 each year, and you reduce your interest income by the amortization. Again, if I was a cash basis taxpayer, and instead of buying the bond on January 1st, I bought the bond on October 1st, but it had just paid its coupon on September 30th. So I'm buying the bond $1,200 on October 1st. And I would normally say, okay, I've got 3 months in the year. I would be amortizing $50 per year. So 50 times 0.25, because we held it for 3 months of the year, would equal $12.50 of amortization. But I can only take the $12.50 to offset interest income. If I have no interest income, I carry it forward. And I'll use it when I get my first coupon in the following year. So next year, what's going to happen is from January 1st to March 31st, I'm going to have another $12.50 of amortization. I'm going to receive my first coupon. And that's going to be $50. And I'm going to subtract $25 of amortization. And I'm going to have net interest income on the first coupon of $25. All right, and then we're going to do this for the life of the bond. And so we're going to keep reducing our interest income by the amount of amortization for the year. And you'll see cash basis taxpayers get a slight advantage over accrual basis taxpayers because we're going to get another coupon September 30th. And that's going to give us again net interest income of 25. So for the year, we're going to end up with net interest income for the year of $50. And then we're going to get an additional 3 months of amortization, and we'll be able to deduct it because we do have enough interest income for the year. So let me just show you what happens there, because that can be confusing. We've had the prior year, we carried forward $12.50 of amortization. And then for the current year, we're going to have $50 of amortization when we take into account all 12 months. We'll have $50 of amortization. And we're going to receive 2 coupons. And our coupons are going to be $100 of interest income. Now, when you add up all of the amortization, we're going to end up with $62.50 of amortization. So a cash basis taxpayer is getting a slight benefit because they're going to have $37.50 of net interest income. An accrual basis taxpayer would have ended up with $50 of net interest income, but this is all going to even out when they sell the bond or when the bond matures. The cash basis and accrual basis are going to come together once again. All right, so this is how the bond premium amortization works. So the last slide that I had is what's a planning technique? What can we do if we have a bond like this? And so let's assume that we bought the bond, buy bond for $1,000, and it has a 10% coupon. And it goes up to $1,200. So the bond increases in price to $1,200. If I just hold on to the bond and I don't do anything, I'm going to pick up $100 of income every year as interest income. And again, we have the 4 years to maturity. And if I had just bought the bond for $1,200, I'd be able to reduce my interest income by $50 a year. So what I would think about doing is selling the bond. And by the way, no one thinks of this. And so if you tell a client to do this, they're going to be very impressed. You sell the bond for $1,200. So that's your amount realized. We then subtract $1,000, which is your adjusted basis. And you're going to have a $200 long-term capital gain. So again, this has to be a bond that you've held for more than 1 year. You've got a $200 long-term capital gain. And you pay tax at 20%. And what you do is you immediately repurchase the bond. So we repurchase the bond for $1,200. Well, now we're going to amortize the $200 against the interest income that we would have picked up otherwise. So what ends up happening is we pay tax at 20% in year 1, but in years 1 through 4, for the next 4 years, we get a 37% tax benefit. And when you do the math, you're going to find that this always pays. The only time you don't want to do this is with a municipal bond, because with a municipal bond, you don't get to amortize the bond premium. It doesn't do you any good. It's all tax exempt income. So you don't do this with tax exempt bonds, but you do this with any type of taxable bond. You even do this with US Treasury obligations, because for state tax purposes, states don't tax US Treasury bond interest income. It doesn't matter. The federal benefit is so great that this always works. So you're outlaying the $20. If you think about it, we had a $200 gain, and we paid $40 of tax currently. Let's put in dollar signs. $40 of tax currently. And then over the next 4 years, we're going to get a $200 deduction at 37%. And we're going to save $74 in tax. So we're giving the government $40 today to get back 74 in 4 years. That's not a bad rate of return. That's 34 over 40. That's over 80% in 4 years. It's a 20% rate of return. Over 20% annualized. And because these are tax dollars, this is an after-tax rate of return. I mean, you can't beat it. And it's risk-free because you're buying back the same bond that you sold. You're in the same exact economic position. There's no wash gain rule. So it should work. You might want to wait a day. I might want to sell the bond today and buy it back tomorrow, not do it simultaneously. But basically, you're in the same exact economic position and you're saving taxes. And no one's going to tell your clients about this. People just don't think of it. So to the extent you have clients that are holding taxable bonds that are trading at a premium, this is just an interesting trade to tell them about. They may or may not do it, because while it sounds great and I am earning a nice rate of return, when I compare it to the overall value of the bond, I'm not increasing my rate of return on the bond by that much, but it's still an increase. And it also shows that you're being creative. And as I said, no one else is going to tell your clients about this transaction. So I think this adds value if you tell this to your client, even if they don't do it. They're going to be impressed that you've thought about it, and that you've offered it to them. So anyway, so this wraps up the class on market discount, acquisition discount, and market premium. So our next class, which will be our final class, we'll talk about contingent debt and how are contingent debt instruments taxed.